Hi there. In this video, I want to explain to you very briefly. This is not financial advice, but how to use the Stock Penguins tool to find a good company or stock that you potentially want to invest in, and to see what kind of metrics that you're looking for. So then it's easier for you to make a decision on whether you want to invest in the company or not. Okay. So this is not a quantitative approach to this. What I mean by that is that you probably want to look at the balance sheet, look at the data and stuff. I'm giving you general guidelines here on generally what are good companies to invest in. Okay, so in general, there are two types of companies, right? There are non-profitable companies and there are profitable companies. In a high interest rate environment, for example, most people or most investors value profitable companies. Just letting you know, in a low interest rate environment where the interest rate is very low, like 0%, sub 0%, whatever. Last time it used to be not profitable companies that were growing very fast. That is valued because people value growth a lot, like growth at all costs, right? So you got to see what type of macro environment you're in first. But I would just say, in general, if you are an average retail investor, just look at profitable companies. Any company that's not profitable, probably do not put your money there because you are, in a sense, gambling that this company will work out. Okay, and business is very difficult. Okay, so that's the first thing. The second thing is we are gonna look for graphs. All right. Okay, so let me pull up the Stock Penguins charts right now. Okay, and we're gonna go into a business. Okay, we're gonna go into service now over here. All right, so just search whatever stock you have in mind, and then you search it. Okay, so service now is over here. And the first thing you want to look for is increasing revenue. All right, so I would say increasing revenue over time. So over here, for example, you can see I'm gonna switch it to an annual basis. And you can see over the past 4 years, this company has grown revenues from 4.5 billion all the way to 8.97 billion. Okay, they have consistently increased revenues every single year. They are making more and more money. This is a good sign. This means that over a long period of time, they have a record and reputation that they are increasing the amount of money they make. Okay, so that's the first thing, increasing revenue. So I want to see revenue is increasing right here. Okay, in the past compared to last year, they increased revenues by 98%, for example, right? Um, the second one is increasing net income or increasing net profits. Okay, so net income is basically this thing over here. So you can see that their net income is going parabolic. It's basically increasing very fast. Okay, so this is a good sign, obviously, because if they make more money, they make more profit. The company is more stable. There's more cash on the balance sheet. All right. So, but you also want to see that they have consistent record of profitability, right? So some people or some companies, they can be profitable, but then they're only profitable for 1 year. Like you want it to be profitable for multi years, right? You want to make sure that this company knows how to operate their finances, right? You don't want it such that you want the company to be profitable 1 year and then not profitable the other and then profitable again. Like you don't want a roller coaster, okay? You want to invest in safe things because this is your hard-earned money. So you probably should look into that, right? You should probably invest in safe things, okay? And then number three, I would think this is the most important one. To me, it's quite important. But do you think that there's a future narrative here? Is there big sales upcoming? Is there an expectation of growth of revenue? All right. And the question is, do you believe in the growth story? All right. So for example, let's go into a well-known stock because everybody seems to know this. All right. The growth of Nvidia is based on generative AI and AI being the dominant the technology that will basically ensure economic growth for the next couple of years, right? So people are believing this AI thing is going to be the next big thing. It's going to build tons of innovation. It's going to disrupt the economy. It's going to grow and create new jobs. It's going to cause economic growth for a lot of companies. And it's a revolutionary technology, right? So that's the growth narrative. And you can see from the numbers, on every single metric is green, right? Okay, so this one is red, but green, EBITDA green, free cash flow green, so everything is going up in the right trend, right? And the question you have to ask yourself is, do you believe that at this point in time, if you buy the stock right now, do you believe that this company will grow at the same clip as before, or do you think it'll grow much bigger, right? Right now they are making, for example, on an annual basis, okay, they are making $60 billion this year. Okay, let me push it to quarterly so it's more accurate, right? $26 billion in Q2 of 2024. Do you believe that Nvidia can grow to a $50 billion per quarter company? right? If you believe the story, then absolutely, like this is a buy, right? But if you do not believe that it can still grow and grow very big, then you might want to reconsider. All right. The next thing that you may want to consider, um, this is controversial or whatever it is, but you should probably buy it at a reasonable price to earnings. Okay, if it's a profitable company. Okay, so basically, what you can do is you can buy a great company, but at the wrong price. All right. So what I mean by this is that you can buy a big tech name. You can buy Apple. You can buy Google. You can buy a Microsoft. Okay, those in general can grow very. Most of them grow all the time, right? But imagine you don't buy a blue chip name. You buy a smaller name, or you buy a name that you're not so sure with, right? For example, ServiceNow. Okay, I don't know whether you know what ServiceNow is. It's a software company. But basically, you need to ask yourself, it's like, is this a reasonable PE to buy this at? So PE stands for price to earnings, and you can see here the PE is 81. Okay, so basically it means that you're paying 81 times the price for every dollar in earnings. Okay, so what you usually have to do is you want to compare this company versus another company in a similar space. All right, so I'm gonna go into the compare, right, and I'm gonna search ServiceNow. Okay, so ServiceNow is a B2B SaaS company. Let me pull up another B2B SaaS company, and that's HubSpot, for example. Okay, they're obviously not the same business model, but I'm just giving an example, just to give an example, not financial advice. Okay, what you want to see here is that you can see, okay, HubSpot is not a profitable company, so we cannot compare this. You can see here, Salesforce is coming in at a 46 PE, right, versus an 81 PE for ServiceNow. Okay, so you're paying almost, you're paying much more for the same dollar in earnings in ServiceNow versus a Salesforce, right? This means that you're paying a premium for ServiceNow's business, and generally you don't want to overpay for stuff, right? If you're going to buy something, you want to buy it at a reasonable price, or you want to buy it at a discount, right? People love discounts. Don't you love discounts, right? So generally here, for example, if you believe ServiceNow is a great company, great growth story, and you don't care about the PE, it's fine. You can go ahead and buy it. But if you don't believe it's fine, then do consider, because you can see here another B2B SaaS company in the same in like the software space. It's not the same space, but the software space is trading at a lower PE than whatever you want to buy over here, right? And obviously go and take a look at the financials and stuff like that. But you can see it's like this is a better deal. Salesforce is a better deal at this point in time than ServiceNow. All right, so you want to trade at a reasonable PE, and this one is generally you just compare it with your market peers. All right, and then lastly, you want to ask yourself, like, how much growth is there actually? Okay, so we'll give an example of Apple, because Apple is a business that a lot of people understand, because an iPhone is an iPhone. Okay, so the question is, how much growth is there? So right now, Apple is trading at a 3.2 trillion market cap. Okay, 3.2 trillion, which means that, okay, so if you think about it, Apple I just said is a 2.3 trillion market cap. So if you put in $10,000, for example, in order for your $10,000 to go to $20,000, Apple needs to go from 2.3 trillion to 4.6 trillion, which is, if you think about it, a lot of money. All right, it's like a damn lot of money. I'm not saying it won't happen. I'm just saying it'll take a bit of time. So you gotta be patient about this, right? And obviously investing is about patience, and it depends on your risk appetite, how much are you willing to actually buy and stuff like that. But at the same time, just be aware, right? You're not always looking to like 2x your money, right? Sometimes maybe you just want to 1.5x your money, or you want to like 2x your money, but you want to wait 5 years, right? So if you're patient, obviously you can increase your money, but also keep in mind, like, the market cap matters, right? How big the company matters. If it's a smaller market cap, for example, ServiceNow over here is a $153 billion market cap. Okay, so let's write that down. So ServiceNow is a $153 billion market cap. For your money to go from $10,000 to $20,000, right? It needs to go from 153 billion to 300 billion, right? Is it easier for 153 billion to go to 300 billion, or is it easier for 2.3 trillion to go to 4.6 trillion? You can judge based on that, right? But generally, smaller numbers, it's easier to double, to triple, to 5x, right? So it depends on how aggressive you want to be, but just keep in mind, it's like you got to ask yourself, right? How much growth is there? Okay, so these are like looking at the graphs, looking at the charts and stuff like that. All right, and then the non-financial stuff you want to think about is also, does this business have a moat, right? So a moat is basically, for example, in 10 to 30 years time, right? This the competitive advantage, like, is this business defensible against other people, right? For example, Google has a search engine, right? Do you think anybody's going to compete with search engines, right? That's the question you have to ask. Do you think anybody else can come in the space, build a search engine and take the profits away from Google? If you think yes, they can, then probably don't buy Google. If you think you can't, then yeah, you might want to consider Google. And then lastly, the gross margins. Okay, so gross margins is, you can find it over here. You can scroll down. This is the gross margin over here. So gross margin is basically, just to explain to you, gross margin. So you have your price. Okay, your price is $100. Okay, there's something called COGS, or like cost to fulfill. So a company, in order to serve the customer, they need to pay some money, right? So for example, someone sells shoes, they sell it for $100. The cost of the shoes from the factory to them, they need to buy it for 20, and then the gross margin is basically $80, right? So they basically earn the spread of $80. Okay, so this is the gross margin, right? And then so obviously a higher gross margin means you have more money to play with, you have more profits for the company. So that's a good thing. All right. So what you want to look for is like high gross margin businesses. So a high gross margin can be 50%, can be 70%. It depends on you. Depends on how you view gross margin. But I would think anybody who has a 70% gross margin is actually fantastic. If you have a 90% gross margin, that's extremely fantastic, right? So let's take a look at consumer businesses, and let's take a look at software businesses. So let's take a look at a Nike. Right, a Nike is a consumer business. When you buy a shoe or a t-shirt, they need to make the shoe. They need to make the t-shirt, right? So you can see the gross margin is 44%. All right. So is that high or low? I mean, depending on the category, depending on whatever, it may be high, it may be low, right? If I compare, okay, so let me compare a Nike, and then I compare a Lululemon over here. The gross margin for Nike is actually lower than Lululemon. Okay, which means obviously Lululemon makes more money for every unit of clothing sold than Nike. Is that a good thing? Yes, that's a good thing. Yeah. All right. So we can take a look. Google versus Amazon. So Amazon has a search business. Their gross margin is 58%. You can see here. Amazon is a e-commerce business. Obviously, they sell cloud, but then they put all of their businesses in the same entity. And so you can see their gross margin is much lower, right? So you must understand, it's like Amazon is a big business because they have other cash flow, highly profitable businesses, and then they combine it with the e-commerce business. So just keep in mind, like, gross margin matters, okay? But yeah, usually you want to see how the business is doing. And if they are fat, you want to look for fat gross margins, okay? So once again, number five of these things you want to look for, and then you want to look for this as well. All right, that's how you use the Stock Penguins app. If you want to find out new companies, you can also check it out over here, and then you can find new and different companies. All right, thank you so much, and yeah.